is on. Everything you need to get the edge at the end of the market day. This is The Close.
NVIDIA matters, but for today, the macro matters more. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. Alex Steele is off for the day, but we're kicking off to the closing bell here in the U.S. And for much of today, the story was you don't really need NVIDIA for the stock market to rally, but those gains have now faded, and the S&P 500 still clinging on to an advance, but just barely, up by about 2.5 points at just under 55.95. The Nasdaq 100 also little change at the moment. NVIDIA, of course, the big decliner here, down for a third day in 4. The chipmaker had a beat and raise quarter. It's just that its outlook failed to match the highest analyst estimate out there. And of course, treasuries are down, pushing yields up after a $44 billion auction of 7-year notes that was a little bit weaker than anticipated. The 2-10 curve has actually been steadily steepening this week, moving towards a normal positive slope. At one point today, that spread was only 1.6 basis points. Romaine?
All right, let's wrap up the whole market in its entirety. That 55.93 and some of the moves that you're seeing in the Treasury space. Of course, some of those moves really got a big rev up earlier here in the day on the back of those revisions, upward revisions to the headline and personal consumption components of U.S. GDP. A slightly stronger pace for economic growth in the second quarter, as get this, strong consumer spending, strong consumer spending more than offsetting weaker activity in other categories.
Our consumer is borrowing and shopping and paying back, which is really important for a credit business. But so far, so good. We do not see a major slowdown. We do not see a significant pullback in demand.
We've heard that sentiment from other executives. In fact, there's a lot of corporate credence to that trend right now amid a slew of retail earnings just today, really all week over the last couple of weeks that have affirmed that. Best Buy raising its earning guidance today, Gap beating sales expectations, and Kohl's boosting its full-year outlook. But there are some cracks out there. Birkenstock plunging the most ever after missing high expectations on Wall Street. American Eagle Outfitters coming up short as well. And we have to talk today about Dollar General, which cut its sales forecast as still high inflation and interest rates keep lower income consumers on the sidelines. But for now, investors are at least trying to take that in stride, embracing a still resilient macro picture to bid stocks up enough here that the major indices are poised to erase most of their losses from earlier this week. A bit of a thumbing of the nose, if you will, to the slumping shares of NVIDIA, which we should point out, hitting session lows over the last few minutes here. The outsized weighting on the S&P and the Nasdaq, though, failing to drag the rest of the market completely down with it, though, as Scarlett pointed out here, we are seeing a little bit of pressure right now on the S&P Nasdaq as we get closer to the closing bells. We're also getting some breaking news on NVIDIA. This is actually more a story about OpenAI and its latest funding round here as that company now flirts with a $100 billion valuation. We learned a little bit earlier that Apple was part of that funding round. And now, Scarlett, we're learning just now, crossing the Bloomberg terminal, NVIDIA said to be part of that funding round as well. And
okay.
Why wouldn't they be?
Right, of course. It adds to the complexity of the NVIDIA story, and we will get to that later in the hour. But I do want to go back to the state of the economy, which is faring better than we initially thought. So you look at this chart, the blue line tracks the quarterly GDP prints, and you can see an acceleration in the April to June period from the first 3 months of the year. That is a revision up from the initial estimate of 2.8%, now 3%. And it's thanks in large part to stronger consumer spending. Of course, these are all backwards-looking data points, which is why we look at the white line, which tracks the Atlanta Fed's GDP Now index. And what it signals is that the economy will likely slow down to just under 2% growth in the third quarter. Romaine?
And before we get started here, Scarlett, I do just want to bring some other breaking news. This on Secure Works. The shares had been halted, and we're now learning why. Apparently, Dell Technologies is exploring a sale of Secure Works. Remember, they had a relatively large stake in this company, and we were reported late last year that Dell was actually thinking about increasing that stake, but was also considering other options. Now, Reuters saying today that that option, at least based on the Reuters reporting, is a sale of the company. We'll continue to keep an eye on that as the news comes fast and furious. A week here that, well, should have been a relatively quiet week. Last week of August here when most people are away, but of course a lot of catalysts out there have kept traders at their desks. Jerome Schneider joining us right now, Managing Director and Head of Short-Term Portfolio Management and Funding at Pimco. I assume a very popular guy these days given some of the moves anticipated in interest rates. Interest rate moves that I think right now, Jerome, might actually be supported by some of the economic data.
Yeah, absolutely. Good to be with you, Romaine. From our perspective, obviously this August has been quite prolific in terms of engagement with clients. Predominantly, it's really been a function of not only weighing what's going on in the earnings segment or equity markets and risk factors like that, but it's also sort of embracing and really extrapolating what the Federal Reserve is going to do over the near term. Central banks have really been a focal point for the evolution of discussion and really driving risk factor markets for some time. And we think that's going to happen and continue for some period of time. What that functionally means is that central banks are trying to normalize interest rate policy, and markets all over the world, investments all over the world are trying to rationalize in the near term and the longer term what that means for the outlook. And for us, in the United States, the Federal Reserve normalizing policy is really being extrapolated that, the rates market is going to move closer to that neutral rate of 3% over the medium term. Now, how quickly it gets there is the ultimate question that makes them a little bit more data dependent.
Well, I'm curious. You use the word normalization, and I am curious as to what expectations are. We had a guest on the program yesterday that really seemed to suggest this idea that maybe we should return to almost pre-pandemic levels of interest rate. Not necessarily saying we should be at zero or near zero, but the idea we should be somewhere close to that. I haven't heard anything out of any of the Fed members, even the most dovish ones, that seem to intimate that we're going anywhere close to that.
Yeah, that seems to be an outlier view if think you're going back to zero. But more of a neutral rate in the context of 3%, give or take a little bit, is probably the context where the landing zone is. From our perspective, really the question is not necessarily the destination, but the trajectory, the road to get there is a bit more nuanced. And it has a variety of factors, including jobs, obviously where growth in the economy now that the Federal Reserve is pivoting to that, and ultimately where some slight implications or inflections of inflation may still be lingering in the economy. Those are factors that ultimately might create slight delays in what the market expects to be a quick ride down to that 3% neutral rate. So to reconcile, rates are moving lower, which obviously makes fixed income more attractive as yields decline, price as bonds appreciate. But at the same time, the trajectory going there may not necessarily be as quick as the market is currently pricing into the market. And that's the tension at hand. A data-dependent Fed means that they're not necessarily data-dependent on every single data point that comes out every single day, but more importantly, to have a more broad-based approach to how they're going to assess the economy, especially now that jobs are going to be the focal point in that context.
Yeah, it sounds like the markets are taking that data-dependent remark very, very literally. So, Jerome, the bond market still sees 100 basis points of cuts this year. As we get more data next week, and of course I'm referring to tomorrow's PCE and also next week's jobs report, and before September 18th when the Fed next meets, do you anticipate a dramatic repricing of those odds or something more ratcheted?
It's probably more ratcheted in this. And this goes to the point that the market is probably overreacting to the pricing of every single data dependency point. And the Federal Reserve is not necessarily doing that. Although the peak of this is going to be in the near term, the jobs data that comes out next week. At Pimco, we're expecting about 170,000 job creation at that point in time. Perhaps the unemployment to slightly tick down at that point in time. But these are just more nuanced aspects that you still have a job environment that is robust, doing okay, but the Federal Reserve wants to move into a mode where there's helping to support it a little bit more. And that's really the pivot that we heard back at Jackson Hole of instead of focusing on inflation and fighting on inflation, perhaps having a little bit of support to the job sector is warranted at this point in time. So when we find ourselves at that PCE number tomorrow and the jobs numbers, undoubtedly people are going to read a lot into this, but there's a lot of time here for us to digest it. And more importantly, the people around the boardroom of the Eccles building, the Federal Reserve, is going to do the same and really take it into context as they approach the September meeting.
So, Jerome, I mentioned the yield curve earlier. It's been steepening. The 2s, 10s curve is still inverted, but just barely now versus around 80 basis points last year. What does this move to positive territory, if we get there, signal to you? How much should investors read into it, given that it tends to be an indicator of recession to come?
Well, there's a couple of factors here. Number one, the normalization of the yield curve is probably a healthy thing as we move to this. And let's put it in context. The Federal Reserve is moving to support the growth in the economy, not to fend off the left tail risk of recessionary factors. And so there's very different motives right now why easing monetary policy is in the discussion for the Federal Reserve. That's number one. Number two, from a practical point of view for investors, the easing policy obviously removes some of the tightness. It doesn't necessarily make that money is easy at this point in time. There's a variety of liquidity conditions which are relatively tight that we're going to have to contend with as we approach 2025 and beyond. And what it functionally means for those that are sitting on the sidelines, sitting in money market funds, is that undoubtedly they're going to see those yields dissipate. Right now is the time to effectively bail on bills, bail out of money market funds, and instead let's focus on the fact that the road to some total return lies in fixed income, not only a counterbalance to some of the volatility we might see in equity markets, but more importantly, some of the price appreciation we're going to see in bonds as the Federal Reserve moves into this easing mode. And so the euphoria of being in cash might necessarily mean you need to move ahead of the curve at this point in time and get out of that cash component.
All right, Jerome, got to leave it there. Jerome Schneider, Managing Director and Head of Short-Term Portfolio Management and Funding over at Pimco, kicking us off to the close here on this Thursday afternoon. Back to that breaking news on Dell and SecureWorks. Those shares on SecureWorks now on halted, rallying about 25% right now. This on a Reuters report that Dell is now exploring a sale of the company. Remember, it controls roughly about 80 to 90% worth of the shares right now. It bought this company back in 2011, took it public, I believe, back in 2018. Bloomberg had reported a few months ago that the company Dell was considering either a sale or increasing its stake in the company. Reuters today reporting that that option on the table right now is a sale. A lot more coming up. This is The Close on Bloomberg.
We're expecting Q3 to have more supply than Q2. We're expecting Q4 to have more supply than Q3, and we're expecting Q1 to have more supply than Q4. And so I think our supply condition going into next year will be a large improvement over this last year.
That was NVIDIA CEO Jensen Huang speaking exclusively to Bloomberg Television last night. NVIDIA, just the latest mega-cap tech name, paying the price of lofty expectations. Its shares down as much as 7%. And at issue, the chip giant's revenue forecast, which topped estimates but by less than what investors have grown to expect over the last 5 earnings reports. Stacy Rasgon, senior analyst at Bernstein Research, joins us now. It's not just the forecast that didn't meet the highest estimate, Stacy. He was also not specific enough when it came to commentary around Blackwell, the next-gen chip. Do you think that this concern that Jensen Huang was too vague in general when discussing Blackwell is because he can't be more granular in giving details, or he won't be more granular?
I don't think the issue was with anything that he said around Blackwell details. The issue beyond the revenue, but the revenue guidance was fine. It was kind of in the ballpark of the whispers. Maybe it would have been better if they could have guided 33. I mean, fine. The bigger issue was the implied gross margins into Q4. So they're guiding gross margins. They said mid-70s for the year. We kind of know where they've come in, so you can back into Q4, and it's a little lower than where people were. It's probably 73, 74%. The street was a little higher. It's just mixed. They've got new products ramping. They're early in those ramps. The cost structure is not optimized. They haven't finalized pricing yet. I think that will resolve as we go next year. But I don't think it was any issues with details that he provided on Blackwell. I think it was the gross margins.
Okay, so that being the case, how do you see NVIDIA share price moving around until we get more clarity on the different issues at hand? Does it consolidate at these levels? What will be the catalyst needed to push it back towards the high?
Yeah, you bet. So by the way, they did say they're going to have what they said, several $1 billion of Blackwell revenue in Q4. To me, several billion would be at least 3. It also seems potentially plausible that their Hopper business, the existing architecture, could also potentially grow sequentially into Q4. So I think Q4 could be a pretty solid, very solid data center quarter. That being said, like the story now is going to be around like next year and like what is Blackwell driving in terms of growth for next year. Again, the investor expectations are high. I still think some of those expectations that are out there still look very plausible to me. And I think as we get more color as you go through the next couple of quarters as to what that Blackwell ramp looks like, and remember they've got all of next year to ramp it at higher content and higher ASP. That's what we're waiting for probably to get the stock. But we might consolidate here for the next quarter or so. Sure, but I think it's fine.
Yeah, and it probably will be. But I am curious, does this give any daylight at all, Stacy, to the AMDs and other, I guess, would-be competitors in this space that I know are playing a big game of catch-up right now?
Not really. I don't think there's any sort of direct read across. We already know AMD. I mean, they kind of said they'll do $4.5 billion plus in AI revenues this year. They'll probably do a bit more. We're at 5. right now. They'd probably do a little more than that. And I've said this a lot, like I don't want to knock AMD. It was 0 a year ago, right? So that's actually fairly impressive on an absolute basis. Relative to what NVIDIA is likely to do, it's not big. I can see where the dollars are flowing. But you know, I don't think there's any kind of direct read across here.
I want to get your thoughts here also on the broader AI space. Right before you came on, Stacy, there was some breaking news here. OpenAI, of course, the darling in the AI space, is going through another funding round that could value it at more than $100 billion. Microsoft has sunk $13 billion into this already. We learned Apple is now said to be part of this new funding round, and now NVIDIA said to also be part of this funding round as well. What do you make of that?
Well, I like at this point, maybe it's easier to figure out who's not part of the funding round. It seems like everybody's in there. NVIDIA themselves, you know, they've taken stakes in a number of AI startups. OpenAI, if it's true, and they did take it, would clearly be the biggest one. But I mean, it's not uncommon for them. They've got a vested interest in making sure that this industry evolves. And again, it looks like many of the large tech companies out there at least are being rumored to be part of that funding round. So I don't think it's that unusual. It makes sense to me.
All right. Good stuff, Stacy. And we should point out Bloomberg, of course, has broken this story as well, of course, citing people familiar with the matter. Stacy Rasgon, senior analyst of U.S. semiconductors and semiconductor capital equipment over at Bernstein Research. Coming up here, we're going to talk a little bit more about AI with all those fancy new gadgets powered by AI tools, enticing customers to shop at Best Buy. We'll explain when we come back. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Tesla, a new analyst coverage over at William Blair that starts with an outperform recommendation, with the analyst saying investors aren't fully appreciating the value of the electric car company's energy storage unit, Tesla Energy. He also says Musk's ability to inspire has led to Tesla creating an Apple-esque ecosystem. Shares of Tesla fractionally higher on the day. Next up, let's look at Cava, the fast casual Mediterranean chain that we can't stop talking about, getting cut to equal weight over at Morgan Stanley. A valuation call, to be sure, with the risk reward for the stock and the analyst view now in balance. The analyst, though, does bump his price target up to 110 from 90, but that's mostly a hat tip to the tripling of the share price so far this year. But he says ultimately, Cava is no longer a fresh money buy and does see limited upside to earnings estimates. Those shares down about 5% on the day. And finally, Foot Locker, an upgrade to overweight from equal weight at Barclays following its quarterly results. The footwear and sports apparel retailer may have a lot of uncertainty on its hands, but that's not stopping the analyst Adrian Yee from seeing the positives, a return to same-store sales growth and an inflection in merchandise margins. Foot Locker getting a nice bid on the day, up about 5% to almost $31 a share. And those are some of our top calls. We do want to stay in the retail space and stay in that sort of context of turnaround stories in the retail space. Shares of Best Buy having a phenomenal day, up more than 17% at one point on the day, the best day going back to March of 2020. Computers, tablets, everything out there, and I'm told mini fridges as well, are really helping this company knock it out of the park in the most recent quarter. Stephen Zaccone joining us right now, Director of Hardlines Retail Equity Research at Citi. He's got a buy rating on the shares. And you have to forgive my surprise at this. I was looking at the stock, and I brought up the fact that this is the best day since March 24th, 2020, which coincidentally was basically the last time I was in a Best Buy when the pandemic hit and we were all rushing to buy computers and printers and everything else we needed to work from home. But apparently I've been missing out these last 4 years. What's going on at Best Buy?
I think, thanks for having me on again. I think it's time to go back. I think that's what today's telling you. You know, we're starting to see replacement cycles, right? A lot of people purchased that technology in 2020 and 2021 when you had a little extra cash in your pocket, or maybe you were nesting and working at home, and that tech needs to be upgraded. So Best Buy had a really strong quarter on the tablets and computer side, and it was largely driven by replacement cycles, people coming in who needed to upgrade their old technology. You know, in addition, you're starting to see some AI influence newness roll into the assortment. It's very small, but it's slowly rolling pulling into the assortment, and that's really the opportunity as you go forward.
But make the case for me, Stephen. I mean, they're still basically a third-party reseller. There's a lot of us who need to upgrade, but a lot of us can go directly to Apple or to Lenovo or wherever we get our electronics from. What is the selling point for me going into a Best Buy and buying?
Yeah, it's a great question. I think they still have that last man standing advantage, right? Like, they're really the only pure play consumer electronics big box retailer out there. You know, they have been challenged the last couple of years because there hasn't been a lot of innovation, there hasn't been a lot of newness, but now we're at the point where there finally is. There's a reason for the consumer to come into that store, to go to their website, to make some purchases. They do very well during that period. You want to see the product, you want to test out the product. Best Buy tends to outperform during those time periods.
You know, I think part of the reason why Romaine and I were so surprised by what we heard from Best Buy is because I was there recently to buy said mini fridge, and the stores looked pretty empty. It was not like there was a ton of foot traffic, and the store shelves were pretty bare. It doesn't really square with the results that we got.
Yeah, I mean, listen, I think the business has been challenged for some time. You know, we've had about 10 or 11 straight quarters of negative same-store sales growth. They've done a really good job managing inventory in the business. You know, one of the prowess of Best Buy is the margin profile has been kind of rock solid despite all these challenges. Gross margin expanded in the quarter. It has been on a upward trajectory despite, you know, this track record of negative same-store sales. So they've really done a good job on that retail 101 blocking and tackling. I think now as we move forward, right, and you start to see more traffic come back to the box, the business pivot to growth, you should start to see, you know, more inventory on the shelves, you know, more demand. I think that's really what we're starting to see here, that inflection.
All right, well, moving forward, how does this set up Best Buy for the crucial holiday selling season for them, the holiday shopping season for the rest of us, in terms of their ability to hold to prices versus having to discount to get more people in?
Yeah, I mean, it is a promotional backdrop. I think one thing that's appealing about a Best Buy, right, as a shareholder, is they work a lot with those vendors that you mentioned before. So they kind of share in the promotions, right? They're not really at risk of having too much product and needing to mark that down after Christmas, right? They work with the manufacturers of the world to share in that promotional messaging. Yep. They also are going to get really good access to product that's selling, that consumers really want during this holiday season. So I do think as we get into holiday, you're going to have more newness from some of those manufacturers. Maybe we get some exciting news from Apple in a couple of weeks that drives some more interest in the category. Yep. And Best Buy is really well positioned to capture that.
All right, Stephen, really appreciate your joining us today. Stephen Zaccone, who covers hardline retail over at Citi.
I love it. Last man standing. I kind of forgot about that because they're really, where else are you going to go, right?
Yeah, it's true. I mean, you could go to Walmart or Target, but like it's not quite the same.
What else was out there? PC Richards is still around for some reason.
Yes, but in limited doses.
Do they sell stuff?
They do sell stuff, Romaine. Coming up, we've got Sara Silverstein, CEO of the Arena Group, joining us to talk about the future of digital media. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. You know, given that it's late August, there's a lot of news flow right now.
Yeah, I mean, this has been an incredibly busy month if you were in the financial markets right now. But we know why, right? Slew of earnings that surprised a lot of people, both good and bad. A slew of economic data that surprised folks good and bad. And then, of course, whatever the heck the Fed is doing. Are we getting more Fed speak today?
Probably, from your favorite Bostick.
Is Raphael Bostick like contractually required to speak every day?
So far this week, apparently, it seems like it. Let's also talk about what's happening in media, specifically digital media.
Is it good?
It's good. The Arena Group is on a mission to reducing costs to boost profits. Arena, by the way, responsible for brands like Athlon Sports, The Street for finance coverage, Parade for fashion and personal wellness, and Men's Journal to cover the trends in food, travel, and the luxury lifestyle. More than 200 brands overall. Here in studio with us is Sara Silverstein. She is CEO of the Arena Group, to join us to talk about her turnaround efforts. So, Sara, you were named CEO in April after running the business side of TheStreet.com, the finance vertical. I know you've taken a hard look at costs, made a lot of reductions, $40 million worth on an annual basis, which includes dropping some brands. I mentioned more than 200 brands. How many brands do you want to end up with?
Well, we are trying to focus. That's a big part of our cost reduction. We have about 200 brands, but our flagship brands are responsible for most of our audience, which you mentioned: Parade, The Street, Men's Journal, Powder, Surfer. And we get about 100 million unique audience members coming to our platform every month on those sites. I think one of the big things that we do need to do is focus on the brands that are bringing in the audience.
So let's talk about some of those brands that bring in the audience and across the different verticals. What kind of audience crossover is there across those verticals? Or does lifestyle, say, require its own strategy that's different than finance or adventure?
That's one of the big things we're working on, too, is finding the ways to leverage the brands inside Arena. So not only finding ways to send audience from one brand to another and commerce opportunities from one brand to another and newsletters and things like that, but also our technology. So how do we serve ads better? How do we, use AI solutions to find the right solutions for each audience member as they come to whatever site they're on?
Do you need that overlap, though? Because some of those seem pretty distinct. You're going to have a lot of people that are interested in the sports that have no interest in maybe, the entertainment stuff, and people who are reading Men's Journal maybe don't care about finance.
Yeah, and that doesn't really matter to us. In fact, it helps us broaden our audience, because what we're really focused on is finding real audience and engaged audience and identifiable audience. We've really shifted our goals from just traffic and revenue to sustained profitability and also engagement and purposeful actions.
We'll talk about how you do that. We'd be remiss in not pointing out there have been a lot of people who've tried this and failed.
Yeah.
And it's a tough business. What do you do to get that profitability? Is it increasing the readerships or increasing the monetization of that, or is it bringing down your own corporate costs?
It's both. In fact, instead of cutting costs across the board, we've made some drastic measures, like getting rid of our entire direct sales department, which was a really hard decision. We had a lot of great people there, but it was really important for us not to have to cut everywhere. We didn't cut journalists. We didn't cut technology. The margins that we were making in direct just weren't there, and we feel like we can get to sustainable profitability on programmatic if we focus on our technology and our audience.
So in terms of formats, in terms of content, you can choose print format. Of course, you can also choose video, and there's horizontal. Then there's also vertical. You can also choose live events. I'm curious, what formats do advertisers prefer, and which formats does your audience gravitate towards?
Which ones the advertisers prefer is not necessarily what we're focused on. We're focused on what we can create and be sustainable in. And digital media really works well for that. We do print some publications that are really valuable to our brands.
Yeah, Parade, right?
Yeah. Parade actually used to be print and isn't print anymore. We have a digital edition, but we do have a Powder magazine and a Surfer magazine, and our Athlon Sports brand has quite a few different editions, special editions that we print. And those are great for our brands, but the way that we leverage our brands for revenue is really the digital side of it.
My wife and I were reading Powder last night.
Were you?
Yeah, because we were planning our Christmas, and we're taking a big family.
Oh, makes sense, makes sense. I want to ask you about the finance vertical, because
you didn't need to know that,
we're Bloomberg.
But I offered it anyway. So.
No, I do.
We talked about the meme stock craze and how that's given way to the AI frenzy. And, people are even holding NVIDIA earnings watch parties. What's the current breakdown between, say, casual investors versus professional investors in something like TheStreet.com?
So we have The Street. We have an audience of investors on The Street. But The Street's audience is broader than that. It's also, we cover the retail side and the investment side of most companies. We also have The Street Pro, which is our subscription service for investors. And that's really for people that trade at least 100 times a year or have $100,000 in their portfolio.
Well, I am curious about that. When we talk about the long-term viability of this business model, does it exist as ad-only, subscription-only, or a combination of both?
I don't think it's going to be a subscription-only or supported by subscription. We love the subscription business. I think our business can be supported by programmatic ads because we have cut so much of our spending around getting that marginal extra dollar for the direct. But really what we're looking to do when I get excited about media in the future is I see things like Bloomberg that has a great product, which is the Bloomberg Terminal, and it's associated with a media company that serves a huge audience that all also use the terminal or could be potential users of a terminal. I look at the Robinhood trading app, who which has done a great job to democratize trading. And now they're building a media arm. And so we already have an audience of 100 million people every month.
Yeah.
And so what can we do with that audience to serve brands or to draw in more revenue?
And do you have plans right now to expand, meaning buying other properties?
We are a publicly traded company, so we're exploring a lot of different options, but I can't say exactly what we're looking at.
Just whisper. No one's watching.
Absolutely.
Okay, yeah, all right.
Hey, plenty of people are watching, Romaine.
All right, Sara, this was a great conversation, and obviously one that hits close to home for us, and I think it hits close to home for a lot of investors out there, really taking a closer look here at the new media landscape. Sara Silverstein, CEO of the Arena Group. We continue to count you down to the close here. Stocks oscillating between gains and losses, at least for the S&P and the NASDAQ, though the Russell getting the strong bid on the day. When we come back, we're going to take a look at one of the biggest decliners in the S&P today. That's Dollar General. And you want to hear what the CEO had to say about the health of the consumer. It's our stock of the hour, and it's up next. This is The Close on Bloomberg.
That's an ugly chart.
Let's take a look at shares of Dollar General, tanking right now, down about 30% after the discount retailer reduced its full-year sales forecast. And the CEO had some interesting comments here about the low-income shopper. On an earnings call with analysts, the CEO warned when it comes to lower-income consumers, inflation has continued to negatively impact those households, with more than 60% claiming they have had to sacrifice on purchasing necessities, basic necessities. Abigail Doolittle joining us right now to talk a little bit more about this. And I was taking a look. First of all, this stock, 1,700% higher than the 20-day average in terms of the volume on this stock right now. And the comments by the CEO struck me as odd, because I thought when the consumer was pinched, all they buy are necessities. But he's basically saying, look, they're not even buying that.
Yes, they're making choices. The consumer that has an income of below $30,000 has choices whether to buy one roll of paper towels or buy something on sale. I mean, choices that a lot of people are not thinking about, but that is the state of the truly low-income consumer, and it's pinching them. In addition, they're saying that Walmart has actually grabbed available market share. So that's another piece of it. Another piece of this story is apparently within the value segment of retail, say 8, 9, 10 months ago, it was very clear that promotions needed to be used. But for some reason, this company was not seeing that writing on the wall while competitors did. And so they're behind they're playing some catch up there as well. So
and that was a big story on Target this quarter, was they finally had their come to Jesus moment and realized they needed to cut prices.
And they somehow kept margins too.
Yeah.
I mean, Target had the best of both worlds in terms of cutting the prices on staples, but then having discretionary, but Dollar General not having that at all. On the other hand, comp sales are positive. If you look at the numbers, it's actually, the absolute numbers are actually really big numbers. In the first quarter, they talked about a turnaround, and there were signs of a turnaround, and it just didn't extend into this quarter. And I think that's really the stock, because otherwise it really seems overdone.
Did any of the analysts who followed the company say anything encouraging about what's to come or how the company can pivot to kind of meet the moment?
Well, I think that if we're to focus on the positive, the same-store sales still positive. Traffic was positive. So it's a matter of really capitalizing on those customers in there, getting them to buy. We keep talking about this bifurcated customer in terms of customers who, or retail that is doing well, retail that's doing less well. This is an area where it seems like there's some operational challenges, and then their core customer, again, having some difficulties.
I am curious, though. I mean, let's go back to the competition, too, because I was speaking on another program here on Bloomberg with an analyst who kind of talked about this idea that those consumers are still spending. They're just not doing it at Dollar General specifically. Yes. And you mentioned Walmart might be stealing some market share. He mentioned a couple other companies that were also seeing similar moves here. If that is the case, if that is true, that they're still spending but just elsewhere here, how does Dollar General even get those back? I mean, do you have any insight into that?
Well, it's interesting, Romaine. So it's not clear to me that they are still spending entirely. It seems as though there are some folks within that low-income category that they're trying to make the same amount of dollars stretch much more thin thinly, so they're having to make these strategic decisions. And though Dollar General said that that's what they're seeing within their stores.
Yeah.
On the other hand, yes, Walmart, business going to Walmart. So I think that Dollar General, it's a matter of probably the promotions and the marketing, the promotions that their competition have been using, seeing that writing on the wall, getting those out there, and
stuff was already
back
cheap.
in.
And granted, I've never actually set foot in a Dollar General. I know you're shocked by that, Scarlett. But so I don't know. But I was always under the impression that they were already kind of a low-priced retailer.
Which makes you wonder how you can discount or really launch promotions in that kind of environment as well.
Well, I think it's on a relative basis. So it may say relative to a Target seem like it's a very low price point, and that may be the case. But if the low price point is Dollar General's starting ground, they will be able to promote against it. At least that's the wisdom out there.
It'll be interesting too. We get Dollar Tree next week, so we'll be interesting to see whether there's a different story there or the same story.
And Dollar Tree, by the way, down about 9-10% today.
Yeah, 10%
on
drop.
Dollar General's latest results and the commentary. So,
how do you decide between a Dollar Tree or a Dollar General?
Whichever one's in your neighborhood.
Okay.
Yeah. It's geographic. All right, Bloomberg's Abigail Doolittle, thank you so much for the latest on Dollar General. Really a stunning move there. Big Lots, by the way, also down quite a bit too because with bankruptcy filing too.
They might.
They have other issues.
That's a whole other story. Yeah. Have you ever been in a Big Lots?
I have, yeah.
Yeah. I mean, because you are the retail queen, because we've learned you're like a titanium member at Costco, right?
Yeah.
My
membership level goes up every time we talk about this.
Single-handedly kept Birkenstock in business. And, and apparently you know all the discount retailers as well.
Yes,
I got to come hang out with you sometime, Scarlett.
You can spend your weekend with me. We have a lot of other retailers that are going to be reporting earnings after the close. So just to give you a sense of what else is coming up, Abigail mentioned, the K-shaped economy. On the other end, you have Lululemon, which is marginally higher by 1%. Ulta Beauty, kind of a beauty supermarket.
I'm interested in that. We were supposed to get Gap. Do you see what happened this morning with Gap?
Yeah, that was a surprise.
Yeah. All right, a lot more coming up. Carin Pay over at Fiduciary Trust will be joining us in just a second. This is The Close on Bloomberg.
The market is probably overreacting to the pricing of every single data dependency point. When we find ourselves at that PCE number tomorrow and the jobs numbers, undoubtedly people are going to read a lot into this. But there's a lot of time here for us to digest it, and more importantly, the people around the boardroom of the Eccles building, the Federal Reserve, is going to do the same and really take it into context as they approach the September meeting.
That was Pimco's Jerome Schneider, who kicked us off to the close just about 50 minutes ago, talking about that economic data that ostensibly kicked off this market today. We saw a pretty strong bid earlier in the session in stocks, a big sell-off in bonds, but that's unraveling a little bit, at least here in the equity markets. Take a look at the board right now, Scarlett, right on the screen.
Yeah, although the sell-off in treasuries has held, not a great 7-year auction today, but S&P 500 right now unchanged. For a while, it was higher, and that was without the help of NVIDIA, which is pretty remarkable given what we've seen over the past year and a half in that move upwards in NVIDIA stock. Dollar General and just kind of the concerns that it raises might be one reason why. Certainly the consumer, we know, especially at the lower end of the income spectrum, is struggling. Yeah,
certainly some concerns there. You're seeing that reflected in the S&P now, basically unchanged on the day. The NASDAQ indices each down by about 0.1%, and the Russell 2000, which had been up more than 1.5% on the day, now only up by about 0.6%. Of course, a lot of this is wrapped up in sort of corporate fundamentals as well. Let's get to our next guest to help us count down to those closing bells just about 8.5 minutes ago. Carin Pay joining us. She's Executive Vice President and Head of Portfolio Management at Fiduciary Trust International. Great to have you here on set here in Studio 2.
Thanks so much.
Absolutely. And I actually do want to start off with earnings, because now that NVIDIA's out of the way, we can just basically say the earnings season is effectively over. I know we've got a couple stragglers coming down the pike over the next couple of sessions here. What do you make of it, though? I know in aggregate, we beat. We're above historical averages here. But do you think it was an encouraging earnings season?
I do think it was a fairly positive earnings season. However, I would say that in terms of guidance, we do think that the market's really starting to differentiate, and companies are differentiating amongst themselves. So we definitely saw that we saw companies that demonstrated pricing power. We saw companies that struggle in terms of demand, that if they have exposure to China, they're seeing some weakness in their business. So I think that you're seeing companies actually show different results, and it's not all just moving in one stroke.
When you look at I guess, the way companies are managing their own costs? Because this has been a big part of the story. You've seen a slowdown in revenue growth in a lot of these companies, yet they've still managed to beat expectations on the bottom line, primarily because of their own either cost cutting or other sort of internal initiatives here. Does that stick?
Sure. I think companies have been doing a really incredible job in terms of managing costs. I think that, we have seen wages, we have seen costs on the commodity side come down over the past year. So things like that are helping companies sort of manage their businesses pretty well. But I think in general, companies have learned to run things really, really tightly from the pandemic, and that behavior hasn't really changed. So I expect that companies, when they do their budgeting, they're going to be very cautious as well. So cost cutting, productivity is still very much high on the priority list for companies.
They're going to be cautious when they do their budgeting. What does that say about how they're shaping their outlooks? Are they conservative in giving outlooks? Because so much of the stock's reaction, the price action, is driven by the commentary and the posturing around the outlook and less so about the actual results for the quarter that ended.
Yes, so I think you're right, but I also think that the markets are just really working with very high expectations, and high valuation. So even when companies are beating, and in general, as Romain said, companies did report very solid earnings, guidance has been good, but the reactions are not necessarily as positive because you already come in with pretty high expectations. We did get 12% earnings growth, and I think one of the things that we want to look for the rest of the year is for the markets to sort of broaden out and expand to other areas beyond technology, because we should expect technology growth to decelerate. Still really healthy, but a decelerating rate, and we need the rest of the market to pick up some slack.
Okay, so which sectors are likely to pick up the slack when we come back from Labor Day and we really kick things off in this sprint from September to Thanksgiving?
Sure. I do think that, investors should be looking for valuation opportunities where there may be, and it's not necessarily sectors, I would say. I think it's really more from a factor standpoint. We're really focused on cash flow yield, and you do see that expressed in sectors like even utilities, right? There are opportunities there, and I think utilities actually is a great way to invest in some of the demand that's coming on as a result of the CapEx spend on technology. So I think it's more thematic in nature and not necessarily sector by sector.
Yeah, it's kind of interesting. We were talking yesterday, utilities was like the best performing sector in the S&P, and I think on a monthly basis it's going to rank pretty high. I'm curious about the macro conditions. We had a GDP report today that was relatively positive, at least in terms of consumer spending. We get a big inflation report tomorrow here. When you look at those economic fundamentals against the backdrop of what most people expect, which is the start of an easing cycle mid-September by the Federal Reserve, is that going to be a tailwind for the market?
I certainly think so. I think the market's really looking forward to a rate cut in September, maybe even a rate cut and a half. So I think that it is definitely driving markets in terms of the stock market's always forward-looking. So you're starting to see home builders do well in anticipation of rate cuts or the beginning of an easing cycle. I think the markets are really dependent on rates still to this day, and so we are starting to actually see some of that play into the rotation a little bit in terms of stocks that are more interest rate sensitive doing better. I think that what will be also important as we move forward is liquidity is such a big factor in markets, and it's very much a global phenomenon. Right? We saw that with the unwind of the yen carry trade. The dollar is really weak at this point, and so there's definitely some leveraging going on there. So I do think that we need to be thoughtful and careful about that as we assess, some of the risks that might be out in the marketplace.
Do you find opportunities right now outside the U.S.?
We're actually more cautious on things that are outside of the U.S. or markets that are outside of the U.S. I think where there could be risk actually is potentially some credit issues coming out from China or the emerging markets. I think that the issue with the Chinese market continues to be a deceleration in terms of the property market, or rather even a decline, right, in terms of the property market, and that's really weighing on consumption there. And you're seeing that reflected in even U.S. companies that have exposure to the Chinese consumer.
So that will be mainly concentrated or pocketed away in overseas markets, but you do see some reverberation, specifically in China-facing companies. Could it have a bigger impact in terms of on sentiment or on just, increasing nervousness before a critical fall in which we have a November election that already has a lot of uncertainty on its own?
Yes, I do. And that's something that we felt in July in terms of concern about what's going on in the Japanese market, for example. So definitely there could be reverberations. And I think this market is very dependent on momentum and very dependent on sentiment. So we just, could see a narrative shift, and that could affect valuations and bring valuations down.
Speaking of being very dependent on momentum, what is the number one question that your investors are asking you when they get you on the phone?
I think that investors generally have been pretty complacent. I think that's also seen by the market behavior as well, right? We have not seen a major pullback. I mean, the pullback in July was probably one of the biggest that we've seen in a while. We do expect that volatility will continue to pick up. Certainly as we head into U.S. elections, we expect that would create some volatility. And, I think that investors generally, surprisingly, have been pretty complacent and not too worried. And that could also be something to be mindful of.
Yeah.
All right, Carin, great stuff, and great to have you here in person. Carin Pei is Executive Vice President and Head of Portfolio Management at Fiduciary Trust International, marching us to those closing bells. Less than a minute until we get there, Scarlet Fu, and stocks basically hanging out where they were. The last time we checked the market with an S&P 500 unchanged on the day, the NASDAQ in the red, down about 0.2%.
I was looking at volume because we were joking around how, Wednesday was the high water mark for the markets this week because of NVIDIA's results. And at the start of trading, in the first 30 minutes, I'd say, volume was above average. But since then, it has really turned around. And now we're about, 10% below the 20-day average.
Yeah, it's kind of interesting, too. We talk about this being what ostensibly should be a relatively quiet week, the last week of August, heading into a major U.S. holiday, and yet traders have had a reason to stay by their desks. The Dow Jones Industrial Average looks like it is going to finish the day higher, and that is your bright spot on the day, up by about 240 plus points, or about 0.6%, 41,335, as we wait for the numbers to settle. 55.92 on the S&P 500. Well, if you're doing the math, that's pretty much exactly where it was yesterday, unchanged on the day. The NASDAQ Composite down 0.2%, and the Russell 2000 holding on to its gains. It was up about 1.6%, but it's going to finish the day only higher by about 0.7%, Scarlett.
Yeah, right now the S&P 500 unchanged, so you would think that you'd have an even split when it comes to the sector performances. Not really the case. You've got 7 groups in the green, led by energy up by 1.25% as oil prices rise. Financials up by 0.9%, and industrials gaining 0.7%. So some of the more cyclical, you could argue value stocks there doing a little bit better today. On the flip side, tech, consumer staples, and real estate investment trusts losing ground, but none of the groups losing more than 0.75%.
The VIX slightly lower here on the day. The dollar relatively unchanged, and some big volume movers in the market. That includes NVIDIA, Intel, Tesla, and Affirm. Scarlet Fu and Romain Bostic here breaking down all of the market action today, and we're joined right now by Bloomberg's Emily Grafeo and Abigail Doolittle to help sort of parse what we saw today. And we talk, guys, about everything that's happened, and we should point out, too, we're also expecting some earnings results coming out later tonight, including from Lululemon and a few others. Autodesk crossing the wire right now, Scarlett.
Yeah, and this is an enterprise software company, so let's just give you the numbers for the quarter that ended. Adjusted EPS of $2.15 beats the average analyst estimate of just above $2. Revenue for the period, $1.51 billion, also higher than anticipated. In terms of the outlook, third quarter revenue from $1.56 billion to $1.57 billion, pretty narrow range, but it is higher than the consensus estimate. And third quarter adjusted EPS will be $2.08 to $2.14. Analysts were looking for $2.12. And full year revenue up to $6.13 billion, whereas previously it had seen a maximum of $6.09 billion. That stock moving higher in after hours trading.
Yeah, it's kind of, I guess, good to maybe see a software company actually do something well here, Abigail and Emily. And we talk about this idea of the tech trade, particularly against the backdrop of all the hype around NVIDIA, all the hype around AI. And there was some concern here that we were going to see a slowdown in software spend. Emily?
Yeah, now we are at least seeing, for them, it seemed like they upgraded their forecast in terms of the top end of the range for 2025 and also for the third quarter.
Well, like the consumer, there's this story of the haves and the have-nots within tech, even on the day in terms of trading. You have Apple and Microsoft on top, and then you have NVIDIA and Google in the worst. And not that that's exactly software or the IT spend, but it really speaks to, again, divides.
Those shares higher by about 6% here in after-hours trading. We're still waiting on some results out of Dell, Ulta, Marvell, MongoDB, and Lululemon, but we do want to get some of the big movers on the day in the cash session. Let's start with some of the gainers on the day, and that doesn't include NVIDIA, Emily.
It doesn't include NVIDIA, and it's also not hardware. We'll go to hardware. We'll pivot from the software because Best Buy was up as much as 18%, biggest intraday rise since March 2020. Better than expected comp sales, adjusted EPS driven by strength in consumers going out and buying laptops and computers, upgrading from those COVID-era purchases that they made.
Have you been in a Best Buy lately?
So the last time I was in a Best Buy, I bought a humidifier, which I don't think their application or their home appliances department is weak, but it was.
I find this funny. So you bought a humidifier. Scarlett was telling me she bought a mini fridge. None of these are like
I bought a computer.
Are high ticket. Okay, but I was wondering, like, where are the high ticket purchases?
Although I returned it.
The strength is coming from the high ticket purchases, not so much Scarlett and I.
All right, what else you got, Emily?
So I'm also looking at CrowdStrike, biggest intraday gain since June, but it did pare back some of that move upwards. But the cyber name beat second quarter sales, indicating that that global IT outage it caused last month didn't have an immediate impact on results. They did cut their full year forecast, but analysts said basically it was better than feared. And there was a lot of fear after.
Yeah, there was, especially with Delta and, threatening legal action and coming up with a big price tag of $500 million. The concern was if Delta did that, who else was affected?
I think it's now, are we going to see this in the coming quarters?
Yeah.
Will we see those impacts? But at least for right now, CrowdStrike higher. And then I was also looking at Affirm Holdings' biggest intraday advance in a year. The fintech company's first quarter revenue forecast came in ahead of estimates. And they said they expect to achieve operating income profitability on a GAAP basis in the fourth quarter of 2025.
I thought the interview we had with Max Levchin, it was kind of interesting. He basically said, look, people are still spending. They're borrowing. They're still spending, though, right?
Yes, buy now, pay later.
All right. What about some of the decliners here on the day? Actually, we're getting earnings right now out of both Lululemon and Dell. Scarlett, you want to start with Lulu? Why not do
as
that?
a customer of Lululemon, why not? I don't just buy shoes. I also buy Lululemon. All right. It says second quarter net revenue of $2.37 billion, missing the consensus estimate of $2.41 billion. EPS of $3.15, however, does top the expected result of $2.95 for this quarter. It sees net revenue of $2.34 billion to $2.37 billion. That is shy of the consensus estimate of $2.41 billion. Full year revenue will be anywhere from $2.38 billion to $10.48 billion. $10.38 billion to $10.4 billion, and it had seen $10.7 billion to $10.8 billion. So that is a downgrade of its net full year net revenue outlook.
All right, a bit of a miss over at Ulta Beauty. Get this, 2Q comp sales down 1.2%. The street was looking for comp sales to rise by about 1.3% here. On the bottom line, EPS coming in at $5.30 a share. That's also a miss. The street was looking for $5.49, and overall revenue at $2.6 billion, a slight miss from what the street was looking for, $2.61. And here's your forecast going forward, guys. For the full year, the company sees net sales of $11 to $11.2 billion. That's below its previous guidance of $11.5 to $11.6. And for full year comp sales, looking for 0 to negative 2% growth. The previous estimate was for 2 to 3% growth with plus signs in front of them. The street on average was looking for 2%. And actually, before we move on to the others, I just want to get your take on this because I thought this was going to be one of the more resilient companies because we always talk about how beauty products are kind of recession proof.
The lipstick indicator.
Yeah.
Well, apparently Alex Steele is not spending enough on her face that they are missing like that.
Yeah.
Well, I mean, we all got excited about Ulta because Warren Buffett's Berkshire Hathaway bought into it. So there's this idea that, everyone's not pricing it properly. Yeah. He's obviously in it for the long haul and not just for one quarter's results. But these suggest that that consumer continues to be pretty discerning.
Yeah, it really speaks to that idea that the state of the consumer is split.
All right, I do want to make a hard pivot here to Dell. Those shares moving higher here on the back of its earnings report here. The numbers themselves are pretty much a beat all around, both on the revenue side and adjusted EPS. The company also saying here that its infrastructure solutions group, which of course the main group that would potentially be the beneficiary of AI, That revenue coming in well above estimates, $11.65 billion. The street was looking, Scarlett, for $10.6.
I wonder how much of this is due to that refresh, that natural refresh cycle that Best Buy is citing, because Dell sells its computers directly through its website. It doesn't go through a third-party reseller like Best Buy, for instance.
Well, Emily, when you were walking around for your $10 humidifier, did you at all look at the Dell computers or anything?
I did not. Okay. I mean, but I don't know.
And the computer that I bought and returned.
Why did you return it?
It was not Dell. And I decided that I wanted to actually, frankly, save money. I just stuck with the one that I had.
Dell doesn't sell its computers through Best Buy. It sells it through its own website. That's the distinction. That's how it can keep prices lower than, say, I don't know, some of its competitors.
Good to know for when I do buy a computer.
They also mentioned AI momentum in the commentary. Our AI momentum accelerated in the second quarter. So
well, speaking of AI momentum, another chip stock actually reporting, Marvell Technology, also crossing the wire. Those shares higher here in after hours trading. Adjusted EPS a slight beat at 30 cents versus street estimates of 29 cents. And again, that's on an adjusted basis. Revenue also relatively in line, 1.27 versus 1.25 billion estimate on average for the street, Scarlett. Their guidance going forward also slightly above estimates, but only by just a smidge.
Something interesting on Marvell, Dell is actually their top customer. So some connected strength there, it seems, using the SPLC supply chain function in the Bloomberg terminal.
All right, good stuff, guys. Thank you so much for helping us round up the big movers of the day and some of the stragglers in terms of earnings. Abigail Doolittle and Emily Grafeo with our close.
All right, with so many retail earnings hitting the tape today, we're breaking down the entire ecosystem. Coming up, you want to hear this conversation here. If you've heard of the brand, it's called Kurt Geiger. Look at that. Nice little top there with the purse and the shoes and everything else.
They also sell men's clothes, apparently.
I don't care. CEO of this company, Neil Clifford, going to be joining us to talk about the growth of this company and I guess about some of those consumer spending trends. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. It was quite a day on Wall Street here. A lot of activity, a lot of trades, but the net effect of it all was, well, not a whole lot. The S&P 500 had a pretty strong rally to start the day, but finished the day unchanged. The NASDAQ Composite and the NASDAQ 100 each down roughly 1 to 0.2% here on the day. And the Russell 2000, which at one point had rallied about 1.6, 1.7%, closing out the day right around that 2,200 level, up by about 0.7%. The bright spots on the day, well, you can find that in the energy space. XOP up 1.6% here, and a slight jump in yields on the shorter end of the curve.
And when it comes to individual movers, I'm really focused on some retailers because they help tell the story of the challenges that these consumer-facing companies are grappling with. Let's start with Best Buy, jumping as much as 18%, the biggest gain since March 2020. It had a beat and raise quarter thanks to positive comps in tablets and computers. People were replacing their hardware and also buying some new AI chip-enabled devices. This, according to analysts, is a positive sign as we head into the holiday shopping season. Dollar General, on the other end of the spectrum, losing a third of its value in one day. That is the most on record after cutting its full-year sales forecast. And the CEO saying that customers are pulling back on essential goods because they face rising costs when it comes to rent, when it comes to healthcare. Really, it's a sign of that K-shaped economy in which the lower-income customer keeps struggling. And you can see that reflected in Dollar Tree, which, Romaine, you mentioned is reporting earnings next week.
Yeah, on the 4th of September here. So it'll be interesting to see whether what we heard out of Dollar General was specific to Dollar General or in the broader space. And I have a feeling it might be a much broader story here. Yeah. Sticking with retailers, though, we actually did get some earnings just crossing the wire after the bell out of Ulta Beauty and Lulu. Both of those shares moving lower here in the after hours trade. Lululemon actually trimming its outlook here, raising some concerns here about demand and, get this, competition. Poonam Goyal covers this for us over at Bloomberg Intelligence, and she joins us now to walk us through exactly what we learned. The numbers weren't awful here, but as you know, the bar has been high here, particularly for a stock and a company that always seemed to beat Wall Street estimates.
You're absolutely right, but they did miss on sales, and that is cause for concern. Their 3Q guidance was also weak, expecting 6 to 7% increases. If they continue at this clip, I think the plan that they have for 2026 sales to double to $12.5 billion is at risk. So we need things to accelerate soon.
Have we seen the peak of Lululemon? I mean, is this a fundamental shift in consumers' preferences that they don't want to spend $100 for yoga pants?
I don't think there's a fundamental shift just yet. I think the consumer is making choices, is pulling back. So there's some of that going on. I do think that Lululemon still has a lot of opportunity to expand internationally and in their men's business, which both, especially across men's, the category has been expanding and has been gaining some great traction with customers.
Poonam, one of the more interesting aspects of what's going on with Lululemon right now, at least in my mind, was that it seemed like a few years ago, you go back 10 or 15 years ago when they really kind of popped up on everybody's radar. They were kind of only the game in town if you wanted kind of that more higher end, luxury type of athletic wear. They had a whole ethos, a whole culture that was also built around that. There are a lot of stores doing that now. Arlo, you have, Alo, excuse me, you have Fiore, a lot of other companies, and of course the legacy brands like Nike and Adidas have also made inroads into this space as well. So you don't have to go there, do you?
You don't, but the activewear space in general is growing too, right? So you're operating in an industry where you don't need to pull competition, you just need to grow in the growing space. So I think the market as a whole is growing both here in the US and internationally, and many players can benefit at the same time. It's not, I take one from you and I have to, give something up myself.
Do we have reason to believe that the management might be in jeopardy, given that, it's been now a while since the struggles or talk of struggles have been taking place for Lululemon? There was a little bit of a brain drain in terms of some key folks leaving the company. Is there reason to suspect that management might be in danger?
I think they need to show signs of things improving sooner than later. But I do think that, when you look at the trajectory that they've had over the past 4 or 5 years, they have done tremendously well. So the slowdown that we're seeing in the last 2 to 3 quarters is a function, some of product. We saw the breathe-through line being pulled back in the most recent quarter. And we're looking for answers on that, on what happened exactly. But things do need to improve on the product side here, too.
All right, Poonam, really appreciate your joining us. Poonam Goyal of Bloomberg Intelligence giving us the instant analysis on Lululemon, who has cut its full-year forecast. Another company that's cut its full-year forecast is Ulta. We're keeping an eye on all these different retailers that are reporting. You can see Ulta shares down about 7.5% following its latest results. Wendy Liebmann is CEO and chief shopper at WSL Strategic Retail, and she joins us now. And Wendy, we were talking earlier about how cosmetics are like a small, affordable luxury that tends to do well when the economy is not in the best shape. It feels like that narrative is not playing out right now for Ulta Beauty.
I think that's true, but I do think that it's true in general. We used to have this thing we call the lipstick effect, right? So that exactly what you said, when the economy got tough and people couldn't afford those premium yoga pants, they could still afford a lipstick or something similar. I think, again, to the same point, lots of competition out there, lots of places you can go. And it's not that people, and we see in our shopper data, it's not that shoppers aren't at Ulta, it's that they're spending less or they're going less, they're using up what they have first. And if it's not convenient or easy for them, maybe they're now in, Amazon, in other places. Mm-hmm. Landscape is the other piece to that as well. But Ulta's doing a lot of other things that I think over the longer term will help. But I think it is that moment of people sort of cutting back, saying, let me just wait a little bit, use up the last squeeze, right. All of things, just to be cautious because they don't know what the next few months, 6 months will look like.
So what was the rationale behind someone like Warren Buffett buying a stake in Ulta Beauty? And to what extent do you think that really encouraged other investors to take a hard look at Ulta Beauty and say, you know what, I see a lot of potential in this longer term and I want to get in as well?
Again, from the shopper landscape that, as we live in, there's that sense of this is a place that's accessible. It's very approachable. They're doing a lot more work in categories like skincare, which is increasingly important to shoppers. They're adding women's wellness. So if you go in there, if you've got menopause issues, you can find the right products, skincare products, etc. for you. They enhance their loyalty program. They're doing a lot of things that I think will keep them in good stead in the future. And it's not just about a lipstick or a blush or pure cosmetics. So I think their role is very sound, and I can understand from a consumer standpoint that's what people are saying in terms of shopping at Ulta versus some of the other specialty beauty places or department stores or even drugstores, mass retailers.
Wendy, I mean, always great to have you here. I know we're talking about Ulta, but I do want to get your thoughts on another company. We were supposed to get Gap earnings after the bell. They came out a little bit earlier today, and they were actually really good. And I am curious if maybe you could talk a little bit about what seems to be a bit of a turnaround that's a long time coming, but finally seems to really be starting to take hold at Gap, and not just at Old Navy.
No, I think that's really true. I mean, we all, I think, have recognized that the new CEO, Richard Dixon, is a brilliant marketer. He's done a lot of work in making the brand feel, the companies, the brands, feel relevant, contemporary, going back to creating some more differentiation between Gap and Old Navy, for example, and Banana Republic. So in those spaces, I think they feel like they're something that people want to get involved in again. I mean, denim continues to be a very relevant category. Their pricing is clearer. Their website isn't so promotional. Mm-hmm. So I think a lot of the basic things, and also, just creating more relevance with the brand. That's what consumers are telling us when they that business today.
Well, I want you to expand on that, because I mean, you have a ton of expertise in this particular area when it comes to marketing, and how you sort of take a brand that largely had fallen out of favor. A lot of people had left it for dead. I mean, just last week we were talking about the phenomenal turnaround over at Abercrombie and Fitch, another company that kind of had had time pass it by, but managed to catch up here. And I'm wondering, what is the strategy for kind of these strong brands that just fall out of favor, rising back, and reestablishing themselves as a dominant brand, a dominant force?
I think, the consistency there is when you look at the fact that Gap became incredibly promotional, lots of discounts everywhere, not easy to figure out why the design, the look, the feel was different from anything else you can get in the market, high end or low end. And what he has done as the new CEO has really made it more relevant in terms of think about the messaging, think about the visual imagery, think about the music, the cultural impact, which really was always part of Gap, but got very old. Now, if you look at the media they're using, the advertising messages they're using, all of that now feels very much more contemporary. You can feel the beat again. You can almost context. So they've done that, as well as obviously the design they're now offering in the stores across the brands, pretty much.
Wendy Liebmann, always appreciate your joining us and giving us your insight into the retail landscape, CEO and chief shopper at WSL Strategic Retail. Coming up, we've got the top three, but before we get to that, Romaine, I was just thinking about the last time I went to a Gap or a Banana Republic, and I can't recall.
Well, this is so I got two missions this weekend. I've got to go into a Best Buy and I've got to go into a Gap. But you're right. I think the last time I think I went to a Banana Republic was before the pandemic. We used to have one across the street.
Yeah.
And I think I went in there, literally, I was about to go traveling, and then I needed a tie or something meaningless.
And those stores haven't reopened either, so that's another thing. They really cut down their store count. All right, we've got the top three next. This is the close. All right, let's get to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Chris Ellison. He is the billionaire CEO of Mineral Resources, and he's got some strong views on work from home. He basically doesn't allow it. But he's now making headlines for saying that he wants to ban coffee runs as well. He basically told Bloomberg, I want to hold them captive all day long. He wants to keep his employees inside the building.
So you have to be at work every day.
Yes.
And you're not allowed to leave the building?
Correct.
To get, even something as simple as a cup of coffee?
Right.
Okay, that's rich. Is this like his cafeteria that we're showing? Because, people got to eat. He does know that the people that work for him, they need calories.
Well, let's go back to that building.
And sustenance to do their job.
Because this building has a cafe, a restaurant, a gym, a reflection room, and a wellness center. They even have a daycare center that charges 20 Aussie dollars a day. It's a fraction of what outside businesses charge. So he has this headquarters in Perth, which encompasses everything.
Okay. that looks somewhat familiar, but no more comment on that. Anyway, that's a bold call there by Mike Allison here. Keep an eye on another person, Lina Khan. Of course, you know her as chairman of the FTC. A new profile of her that's bringing up an interesting comment she made back in 2013, where she wrote this whole paper for Time magazine about the, quote, chocolate oligopoly. Basically the idea that Mars and these other candy makers, Hershey, Nestle, basically just control everything. And now, of course, she is the main point person, regulatory point person, that's going to have to decide whether to sign off on this Mars-Kellanova deal, a $36 billion deal that would create one of the biggest candy and snack food companies.
Yeah, I love the fact that she's written on this before, and now she gets to decide whether to, you know, hold up any flags.
I have a feeling this article is going to come up in a few court cases.
Probably. Lina Khan, she is the bane of a lot of people's existence, especially those who are event traders and betting on deals to go through. All right, third up is Shohei Ohtani. The MLB superstar has signed an exclusive long-term baseball card deal with Topps. Topps will release cards with autographs and game-used memorabilia in the U.S. and Japan.
All right, there you have it. Ohtani there, our top three here on the day. When we come back, we're actually going to take a look at the birth of Netflix, Scarlett. And here's a question for you before we go to break. What was the original name of Netflix's business?
I knew this before.
Answer when we come back. This is Bloomberg.
Red envelope?
All right, time for a look back at this day in history and to wish Netflix a happy birthday. It was on this day, August 29th, 1997, when Reed Hastings, flush with millions of dollars from selling off his software company that he co-founded, and he teamed up with Mark Randolph, a co-founder of the computer parts mail order company, Micro Warehouse. Now, the legend goes that Hastings was upset at having to pay $40 in fees for the late return of Apollo 13 to his local video store. So a few months later, Netflix was launched, offering subscribers for less than $20 a month the ability to rent as many movies as they want for as long as they want, with no late fees ever, without ever having to set foot inside a store. It was audacious, impractical, expensive, and exactly what consumers wanted. But Randolph and Hastings, they always had bigger plans, including early bets that video streaming would render the DVD by mail service that they had just started obsolete once the technology advanced. That expectation is one of the reasons they settled on Netflix as the company name, and that brings us to our question of the day. What was the original name of the DVD by mail business? The answer? Kibble. Yeah, just like the dog food. Now, for the record, the company only used that moniker for about 6 months before considering other names like Cinema Center, Fast Forward, Now Showing, Direct Picks, before finally settling on Netflix, because let's face it, Kibble and Chill doesn't quite have the same ring to it. Now, the company, of course, would quickly morph into the modern day entertainment empire that it is right now, an empire that took everyone in Hollywood off guard, launching in 1997 with 30 employees and around 900 titles, a number that has now ballooned to 16,000 employees and almost 7,000 active titles today. Hastings took the company public in 2002 and guided Netflix through its triumphant tussle with Blockbuster.
In the early days, we were like, Blockbuster is going to wreck us as soon as we get big. And we were almost right about that.
Of course, Hastings got the last laugh and in 2007 eventually introduced the streaming service that he and Randolph had predicted a decade earlier. That same year, Ted Sarandos, an early employee who was now at that time in charge of content, decided to spend an almost unheard of $100 million to make 2 seasons of a TV show called House of Cards. And as they say, the rest is history.
Romaine, I'm trying to picture that Netflix whoosh on my screen being replaced by Kibble and a similar sound, and I just can't do it. Definitely glad that they changed it to Netflix from Kibble. Just don't see how that would work out. In any case, that entrepreneurial spirit is what led our next guest to take the reins of one of the hottest luxury fashion brands in the UK. Before he was CEO of Kurt Geiger in 2004, Neil Clifford got his start in retail as a sales associate for Burton's Menswear in his hometown of Portsmouth. Now, Kurt Geiger, the brand, is one of Britain's most prominent footwear and handbag companies, and it's working to expand its global presence. Joining us now for more, I'm pleased to say, is Neil Clifford. He is CEO of Kurt Geiger. Neil, it is good to speak with you. And I know Kurt Geiger is available in department stores like Bloomingdale's or Nordstrom, and you are opening stores in the U.S. You have your first store in Orlando that you opened in May, and you'll be soon expanding to San Diego as well. For those of us who are a little bit less fashion forward and may not be familiar with Kurt Geiger, how would you describe the brand and its vibe?
Well, we're over 60 years old now as a company. Kurt Geiger was a handbag and shoe designer. But I suppose, London is very grey skies often. So we sit here in London, as I am now, and we dream of blue skies, we dream of colour, we dream of embellishment. We've got a big team of 25 designers. Everything's designed here in-house. And we love to offer incredibly creative designs, but also really good value. I think that's our cocktail that's really, surprised us, actually. We've almost, in 5 years, we've grown 100 times in America, from $4 million 2018 to over $300 million now.
And why is the right way to offer that cocktail through handbags or footwear?
Well, we're in the US, we're about 65% handbags. We started as a handbag brand in America. We started as a shoe company in the UK, but now the US is our biggest market. It overtook the UK for us about 18 months ago. So we would say we're a brand offering all categories of design and great value: sunglasses, swimwear, jewelry, handbags, footwear, men's and women's footwear. And as you say, we're in 400 of the best department stores across North America now. So we couldn't be happier, to be honest.
What do you find when you talk about the strategy of reaching the consumer, Neil? Do you think the strategy is going to be more fruitful by relying on those department stores, those third-party sellers, if you will, or is it more direct to consumer, your own stores, your own website, the better approach?
Well, our strategy is threefold, all of those channels you mentioned. We're very, very proud of our relationships with our department store partners. They've really been the engine of our growth in the last 5 years and, in a way, our brand awareness building. But our digital business that was $1 million 3 years ago is now $70 million in North America. And now, as you mentioned, stores we've opened our first store in Orlando in May. We've learned so much about how important Mother's Day. In the UK, we buy chocolates and flowers. In the US, you buy handbags. So we opened 4 days before Mother's Day in the Millennium Mall in Orlando, and it's by far exceeding our expectations. So we'll open 3 more stores this year: San Diego, New York, and Los Angeles.
I am curious here. I mean, you mentioned handbags, and yeah, if you open up, in my bedroom closet, all my wife's, 50,000 handbags that I all bought her will fall out here. You guys have also recently made a big push, though, into men's footwear in a way that I guess kind of catches up with what you've been doing with women since, the 60s or whenever you guys started here. Give us a sense as to what is different about trying to market this brand, which I think in a lot of people's mind is distinctly feminine, and doing this in a way where it's going to be palatable, what I would think would be a different way of approaching the male audience.
Well, men love looking wonderful too.
I know.
Men,
have you seen me? Yeah.
men love color. Yeah. Men love incredible value. They love to stand out as much as women. In fact, we often say men are the new women. We
I like that.
We have it's about 15% of our company, so relatively small at the moment. But we are half of the population of the world, so we shouldn't be left out.
I'm glad you actually said that, because I've always been, like to have a little.
You felt
fashion.
overlooked?
I don't want to say it's hard being a man, because that might be an overstatement. But we want clothes too. Nice
okay,
clothes,
you want clothes, you want footwear. I get it.
Yeah.
Maybe you want some male handbags, Merces too. Neil, you mentioned the triple-digit growth in the U.S. year over year. I'm curious, as we look at all the different retailers that are reporting across the U.S. This week, are you seeing any weakness in certain consumers in terms of their appetite for acquiring pricey handbags or shoes? Has that changed any over the last couple of months?
No, it hasn't. We've been asked that. We're a private equity backed company. In fact, we've had 4 private equity deals since 2005. So as you can imagine, we have an immense amount of creativity, but we also have a lot of numbers. I've been asked that question a lot in the last 2 months. Mm-hmm. No is the simple answer. But I suppose we're small. Most of our competitors that we would think about, our competitors in the US, we like to think we're better value than them. They're all much bigger, 5 times, 10 times, 20 times, 50 times bigger. So maybe our size and our agility is helpful for us at the moment. But the last 8 weeks, we've been growing at almost 100% to last year in North America.
Are you feeling pressure, though, to kind of scale this up even further, Neil? Or are you kind of comfortable being kind of a mid to smaller size player?
No, we as a management team put pressure on ourselves to grow. You know, growth is a good thing. We can employ more people, pay more taxes. We've recently built a school in our head office, so we want to grow. We'll have 5 more stores at least next year in North America, and you know our view is, and as you can imagine, we've got a very detailed business plan saying this. 50 stores in the next 5 to 6 years and $1 billion of turnover is again, that wouldn't be by far the biggest of the operators. We'd still be quite small, but we think we can get beyond $1 billion.
All right, Neil Clifford, really appreciate your taking the time to explain all of that to us. Neil is CEO of Geiger, and of course they have opened a store in Orlando and are looking to expand further in the U.S.
Including here in New York. I was just going through their website here, the men's part of the website, Scarlet Food. They got some tassel loafers. I've never owned a pair of tassel loafers.
Well, now you can.
So, can men shine?
Men can always shine.
As you pointed out, you know, we are half the population. Men are the new women, according to him.
All right, let's take a look at how markets closed on the day. Unchanged, literally unchanged for the S&P 500, but still a lot of red there because the Nasdaq was pulled slightly lower, and that's because Nvidia closed down 6.4%. Was this a reality check earnings report, or was it just didn't live up to lofty expectations?
I don't know. This seems like more of a speed bump rather than some sort of fundamental shift in the AI trade. But I do think it's interesting how the macro really kind of dominated once we got that GDP report, and we get another report tomorrow morning on PCE. So maybe that becomes, now the earnings season is effectively over, maybe that becomes a dominant story until the next earnings season starts at the end of September.
Yeah, well, and the Fed at the end of September as well. This is The Close on Bloomberg.
All right, welcome back to The Close. The focus on politics right now is presidential candidate Kamala Harris and, of course, the current vice president sat down for an interview with CNN television. It was a taped interview that occurred earlier in the day. It is scheduled to run a little bit later tonight here. She sat down with her running mate, Tim Walz, in a wide-ranging interview. Kailey, Leinz, the co-host of Bloomberg's Balance of Power, joining us right now to talk a little bit more about what we learned. I know you haven't had a chance to actually see the entirety of the interview, Kailey, but a few things have trickled out here. What have we learned, or what do we expect to learn from this interview?
Well, what we have learned based on one excerpt CNN has released is that she was pressed on the policy flip-flop she has made on a number of issues, including when it comes to issues of energy and climate and immigration. Of course, when she was running in the presidential primary back in 2019, she said she was for banning fracking. She does not hold that view now. And when she was pushed on that, she essentially said that the important thing about her policy positions is that her values have not changed, that she still holds the same values that she always has. Now, we are seeing Donald Trump's campaign quickly responding to this. The Trump War Room account has said Kamala Harris is confirming she's still her radical left self when it comes to a number of these things. She did talk about the Green New Deal. She said on that subject she still has always believed in climate, that the climate is changing. And so that's all we've gotten really thus far. What we are going to look for in the entirety of the interview that she did with Tim Walz, which, mind you, she's caught in flack for doing this as a sit down, as a joint interview versus doing this interview on her own, is more refining of her actual policy platform, more explanation of what it is exactly she would like to achieve on some of her economic platforms specifically, and how she plans to pay for some of these policies like $25,000 down payment assistance to first-time homebuyers.
So by sitting down for this interview with CNN, does this open the gates to more interviews with other media outlets? I know that, you know, we still have a debate to get through, the one that has been promised to ABC, but how do they plan to address all the requests for interviews with Kamala Harris?
Well, it's not just about addressing requests for interviews, Scarlett, but also addressing criticism she has come under for not doing enough of them, for only sticking to teleprompter reading at events and, of course, in speeches like we saw at the DNC in Chicago last week. So this is likely the first of what will be many, and we are likely to see her doing interviews like this solo, not with her running mate, Tim Walz, although there is precedent for, after the selection of a vice presidential candidate, doing a joint interview. We saw Obama and Biden do this back in 2008. Hillary Clinton and Tim Kaine did it in 2016. But it's going to be those solo interviews we're watching for next. And you mentioned the debate, of course, that is on ABC on September 10th. The Harris campaign still not has agreed to the rules of having the mics turned off when it's not the candidate's turn to speak, like we saw in the June 27th debate between Trump and Biden. But the fact that this interview took place now potentially, opens up windows where Donald Trump could criticize her on that stage in Philadelphia in just a few weeks' time, but also it may give her an area in which, or an avenue in which she could attempt a recovery from any missteps that she might take in this interview this evening.
All right. Kailey, Leinz, thank you so much. And of course, Kailey and Joe will be back later on at the top of the hour hosting Balance of Power. In the meantime, still ahead on the close, what investors need to watch for as they prepare for tomorrow's trading. This is Bloomberg.
All right, traders are awaiting clues on the Fed's rate-cutting path, and that includes fresh inflation data tomorrow, 8:30 a.m. Eastern Time. Core PCE data, of course, Jay Powell's preferred measure. Simona Mocuta is chief economist at State Street Global Advisors, and she wrote in a recent note that with 3 meetings left, current market pricing for 100 basis points of 2024 cuts is reasonable. Simona joins us right now, pleased to say, here. And let's talk about that, Simona, because this is a market right now that is all in on an easing cycle. And as you just pointed out there, about 100 basis points, a full percentage point of easing just this year alone. The data, in your view, is supportive of that?
Yes, it is, because we are not really basing this argument on tomorrow's data or a single data point. We are basing it on the evolution of the economy over the course of the year, and the idea that, despite the fears we had earlier in the year about an inflation resurgence, those have proven without merit, really, and the trajectory is for further moderation. We should not get overly hung up on a single data point and rather keep our eyes on the evolution over the next 6 months. Our forecast says we'll get to 2% somewhere in April or May of next year. And with Fed funds at 5.5, I think, yes, the Fed does have room to cut multiple times in 2024 and again, furthermore in 2025.
I guess my question, though, is why cut now? So let's just start with the September meeting, where it's widely expected we're going to get at minimum 25 basis points, maybe even 50. If we're not at 2% now, and that 2% maybe not coming until 6 months from now here, what's the advantage of the Fed moving now rather than waiting maybe 1 or 2 more meetings?
Well, I would say, in my opinion, they should have already cut in July. So my argument is based on the idea that it's preferable to move in a steady fashion, right? When you know policy, the ideal level of the policy rate is lower than where you are, you would prefer to get from where you are to where you want to be in a steady, gradual fashion. Why wait until December and then do 50-50 or some dramatic fashion? Not to mention that you have the other part of the story to worry about, which is what happens to the labor market between now and then. Yeah. We were, I think, generally surprised by the rise in the unemployment rate. You don't want to have another one of those surprises and you look suddenly at an unemployment rate that's 4.5%. And you say, well, maybe we should have done this already. So I think right now the balance of risk really would encourage all Fed officials to say that the start of cutting should begin in September.
And you mentioned that the Fed's dual mandate, as it shifts its attention away from fighting inflation, not saying that it's no longer looking at that, but more focused on maximizing employment. Just how critical is this one data point? As much as it's the Fed's favored inflation metric, how critical is PCE going to be to the decision on September 18th?
I think not that significant, to be honest. I mean, obviously the Fed is watching every data point, and all of us are, but at the end of the day, I think you have enough holistic data evidence to say nothing really changes that decision at this point in time. I think it would be some shocking event that I can't foresee right now that would forestall a rate cut in September. That being said, I still think it makes sense for the Fed to start with just a 25 basis point move. You would need a really bad employment report to kind of tip the scale, in my mind, in favor of a 50 in September.
What would a really bad employment report look like, Simona? Right now, the consensus estimate is for growth of 165,000 jobs after 114,000 jobs were added in the month of July.
It could come in a number of forms. It could come either as a big decline, reduction in the pace of employment gains. I think it would be hard to get an outright negative print in the very near term. It could also come in the shape of a higher unemployment rate, which is a little less troublesome because it could be driven by higher participation rate. But either one of those things, as Chair Powell noticed, we do not at this point in time welcome further softening of the labor market. So whether it's because of participation or a decline in job gains, further increases in the unemployment rate at this point in time are unwelcome.
All right, Simona, we really appreciate you taking time for us. Simona Mocuta, Chief Economist over at State Street Global Advisors. A look, I guess, Scarlett, at the broader economic picture here, and I guess, in her view, why the Fed actually has the room to start cutting rates. In her view, she said they should have started cutting at the last.
Yeah, and I think a lot of people will agree with that as well. And I liked what she said about how this ultimately may not be such an important data point on its own. Really, the focus is going to be on the September 6th release of the jobs report.
Yeah, absolutely here. Meanwhile, there are potential market-moving events here over the next 24 hours that could move the markets. We start in the world of politics. We were just talking about this story. Not sure it's going to move the markets, but certainly some interest here. The Vice President of the United States and, of course, the Democratic nominee for president sitting down with CNN a little bit earlier today. Yeah,
this is her first interview since becoming the Democratic nominee, and she sat down with her running mate, Tim Walz, as well. So we're going to get we're going to get the complete rollout actually tonight at 9 p.m. Eastern time.
All right. And in the morning here, we're going to go back to the macro picture and some economic data out of Europe.
France, Italy, and the entire euro area come out with CPI numbers.
And it'll be interesting to see what's going on there. Obviously, a lot of people talk about this 2% target here in the U.S. We kind of forget that inflation rose around the world. Yeah. So what happened here in the U.S. was not unique, and it raises questions about why the policy responses are differing. That could become in focus tomorrow at 8:30 a.m. when we get the core PCE data as well as those personal income and spending numbers, all very important figures for the Fed in its decision to cut rates.
Yeah, I'm so glad you mentioned the personal spending and income numbers, too, because all the focus goes to the core PCE number, but personal income is seen staying unchanged with a 0.2% increase for the month of July, and spending is seen picking up to 0.5% for July.
We're also going to get the final revisions on University of Michigan sentiment data for August here. Those numbers expected to continue gravitating higher. I guess that's a good thing, right?
Yeah, that is a good thing. Although the earnings that we've seen from retailers really suggest a bifurcation.
It'll be interesting to see how that flows into the actual hard data, what we've been hearing out of these companies, and whether it has a material impact. We'll be back tomorrow here on The Close for all of your market coverage. For politics coverage, stick around. Balance of Power coming up next, right here on Bloomberg.